In today's video, I'm going to tell you the truth about the stock market and why, despite what your account balance says, you're not really making any money. What if I told you that despite what your 401k account or your brokerage balance shows, you haven't really made anything in the stock market? Even though the experts will tell you that the market is at all-time highs and you see your balance increasing, it's all an optical illusion. In this video, I'm going to reveal why, despite what your account balance says, you might actually be worse off than when you actually started. We're going to dive deep and expose the truth behind the market, why it's all just smoke and mirrors. And as the market drops like a rock right now, many people are reconsidering their choices. It's time to face the cold, hard truth. The market is not wealth, and if it's not wealth, it can't truly build wealth. Hi, I'm Ryan D. Lee, a non-traditional financial strategist. Over 15 years ago, I saw the truth about the market and I walked away completely. Today, I don't have a penny in the market by choice, and when measured by real wealth, I am richer than I could have ever been using traditional market strategies. In this video, I'm going to show you how to break free from the market's illusions and start building true wealth for you. To understand the truth that I'm about to share with you, we need to first grasp a fundamental concept, the concept of inflation. Think about it. What is inflation? If you're like 97% of the people out there, you'll probably say that inflation is rising prices. We see it at the grocery store, we see it at the gas pump. But that's only the symptom, not really the cause. Most of us have been trained, taught, and educated to believe that inflation is a naturally occurring phenomenon. I mean, if you look up inflation online, you would be told that inflation is just something that naturally happens. Prices go up. What if I told you that inflation is actually a deliberate consequence of increasing the money supply? Listen, Ludwig von Mises, a Nobel Prize-winning economist, warned us about the dangerous confusion surrounding inflation. He says we've been trained to see inflation as rising prices, but that's just the effect. The real cause is the increase in the quantity of money in circulation. If we can't even name the cause, how can we ever combat it? So let's get clear, inflation isn't rising prices, it's rising money supply. Now, before we bring this back to your retirement account, let me ask you, what is the money supply? On an individual level, it's kind of easy to grasp. It's when you make $10,000 a month, that's your money supply. But on a macroeconomic level, the monetary supply of the US economy is something much larger and much more complex. It's an ever-increasing money supply that drives inflation, which in turn erodes the true value of your investments in the markets. Let me help you see this before we actually translate this into your market-based account. Let's take a brief walk down memory lane through the last 4 presidencies starting in the year 2000. Both Republicans and Democrats have failed to understand or have blatantly ignored the problem of inflation, what it actually is, and more importantly, what actually causes it. This has exaggerated it with every passing administration. Leading up to the year 2000, President Clinton created the last federal budget surplus we've ever seen in the last 24 years. President Bush, a Republican, came into office in 2021. During the Bush administration, he racked up more debt as a percentage of GDP than just about any president before him. He added $5.85 trillion to the national debt, representing a 101% increase in the national debt left to him by Clinton. President Obama came in, a Democrat, and he came in promising to restore some fiscal sanity, some discipline to the reckless government spending. But like his predecessor, he did the exact opposite. He grew the national debt by $8.6 trillion during his 8-year tenure as president. After Obama, Hillary Clinton was supposed to come in and keep the gravy train running. But in the 11th hour, Trump shocked the world by becoming the 45th president of the United States. Now, Trump, to his credit, got the economy back on track without reckless government spending. But then COVID happened, and just like his 2 predecessors, he unleashed the printing press in a massive way to fight a disease that money could not cure. When Trump took office, the federal debt was $26.9 trillion, and when he left office just 4 short years later, he had increased the federal deficit by 33%, adding $6.7 trillion new dollars to the economy. When President Biden took office, he negotiated to increase the debt ceiling so the government could continue to operate on an ever-increasing pile of borrowed money, and so far, he's kept up the American presidential tradition of creating new money to keep the government and the economy rolling. At the time of this recording, with President Biden nearing the end of his administration, the tradition of creating new money to fund government spending spending, outlandish government spending, has continued. Today, our national debt exceeds $35 trillion. If we built a Mount Rushmore based on presidents who've done more to distort the money supply by adding more money to the economy, here's what that mountain would look like. Now, here's the point I want to make with this last little walk down memory lane. On average, over a 25-year period of time, beginning in 2001 all the way to today, the last 4 presidencies have injected new money, 8% new money into the economy on average every single year. From President Bush all the way to now, the money supply has 3x'd. There is 3 times more money circulating in the economy, while the GDP has remained relatively stagnant or even declining. This surge in money supply is the true driver of inflation, leading to higher costs across the board. More dollars are chasing the same or even fewer goods, making everything more expensive. With so much new money created without a corresponding increase in real goods and services, each dollar that we have is less potent. It takes more dollars to buy the same goods and services, which brings us back to your investments. An increasing account balance in your 401k, in your brokerage account, in any form of retirement account that you have, it can be deceiving without understanding the knowledge that I just shared with you. Using money as a way to measure wealth is like looking at an optical illusion. The value of dollars is both diminished and overstated in the market. So when a company reports earnings and it seems like it's wildly successful, some of this is an optical illusion created by inflation. But this doesn't reflect true growth. It's just inflation at work. To truly assess the value of the market, we need a measure of wealth that cannot easily be manipulated or distorted like money. Can you think of an asset that has been a form of wealth dating all the way back to biblical times, something that can't be inflated with more government printing? Well, my friends, it's gold. Think about it. From the beginning of time all the way to today, gold has been a store of value and wealth. Gold is a natural resource with a finite supply that can't be manipulated, making it a stable measure of wealth across time and across presidencies. When we price the stock market in gold rather than dollars, the truth becomes much more clear about the real wealth that has been created, or the lack thereof, in stocks and bonds. Let's take a look at this eye-opening analysis. Okay, my friends, what I'm about to share with you can all be found at pricedingold.com. And what this analysis does is it helps us see through the illusion and the fakery of having more money chasing fewer goods and services. The first thing we're going to look at is the real value of the S&P 500 when measured in gold, not dollars. Now, when measured in gold, not dollars, you can see the market actually peaked in the year 2000. Prior to the year 2000, if we go back to 1960, 1965, and 1970, the market, when measured in gold, was around 80 grams a share. That was the average price to get into the S&P 500. It then had a severe decline. It kind of bottomed out, and then leading up through the dot-com, the burst of the dot-com bubble, it reached new heights and new levels, real value being created. Computers in the online industry changed the world forever. But after the dot-com bust, the market fell like a rock when measured in dollars. Now, after 2010, you could see that the market started to recover, leading everyone to believe that quantitative easing and printing new money was actually working. But if we go back and measure this in gold, in 2025, nearly all the way back to 1965, the last 50 plus years of the market have been flat. It doesn't matter what your account balance says. If you measure it in real assets, gold, something that cannot be manipulated with more printing, you have made nothing in the market. The market has been flat now for over 50 years. Let's look at this in the Dow. The Dow Jones, measuring some of the biggest, most successful companies in the entire world, again, priced in gold, you can see if we go back to 1930, before the Great Depression, the value of the market went up significantly, reaching around 600 grams of gold. The market crashed and tanked. It stayed bottomed out, and just like with the S&P, it reached a new height in 1960 and 1970. It crashed again. The dot-com bubble again blew it all the way up, and you can see here are the 3 high points of the market. 3 high points of the market priced in gold. But again, after the year 2000, even with quantitative easing, if we go back now over 100 years, all the way back to 1930, the market is flat. The only increase in value in the market is there's more dollars, giving you the optical illusion that you're making money in the market, when in reality, with real wealth, you are not. Now, let me give you a couple of examples of things to help kind of prove this out. The first thing I'm going to share with you right here is hourly wages. Again, priced in gold, you can see Americans on average made around 3 ounces of gold per hour that they work. And if we go back to the 1970s and 1975, Americans were at the height of their production, the height of their earning potential, but it fell sharply. As manufacturing and industry was shipped overseas, technology came and brought back in new, higher paying jobs. In the year 2000, that crashed again, and today, American workers, when priced in gold, make less money today than they ever have. Our parents and our grandparents, despite what they say, made more money than we did when priced in a real asset like gold. Now, let me give you another example. Let's look at this in consumer prices of gasoline, right? Think about this. Now, technology has made it easier and more cost-effective to produce, to mine, to refine gas, and to bring it to the market. So if we measure it in gold, you can see that the cost of gas when technology wasn't what it is today was relatively high. Okay, but in the 1970s, as that cost came down with technology coming online, the real cost of gasoline to produce was lower and lower and lower. It spiked up a little bit in the year 2000, but today it's cheaper to buy gas than just about any point in time in history, despite what it says at the gas pump. If we look at this with food, again, technology and manufacturing and agriculture has become more cost effective to produce, yet we spend more money at the grocery store. Now, again, that's when it's priced in dollars. If we price it in gold, you can see that the cost of groceries actually came massively down in 1970 and 1980 and 1985, remained relatively flat, and today, if priced in gold, it's cheaper to buy groceries today than it ever has been in the history of the world. Priced in dollars, I spend double today that I spent just 2 years ago. Dollars are distorting the value of the economy. The market is an optical illusion, and while your account balance may have gone up, in reality, you're not any wealthier than you were when you started, and in fact, you're probably poor. My friends, in this video, you learn that the market, it's an optical illusion. The funny money, the fake money that has balloon values has created no real wealth. It's simply the result of more money chasing the same goods and services. This video was meant to raise your awareness, to help you see through the lies, the illusions, and the fakery. That more money distorts the truth, and my friends, it's the truth that will actually set you free. If you found this video insightful, don't forget to like, subscribe, and share this video. Because friends, they don't let friends retire broke, and they don't let friends live in an optical illusion thinking they've got more money in a 401k, because they do, but in reality, they're poorer than they've ever been before. Remember, the goal of this channel is to rise up and live free. It's to take control over your financial future today. So I want you to join the community, start your journey to financial freedom, and I'll see you on the next video. Fearless.